Hey everyone, Schuyler Williamson here. Wanted to create a video today about the decision of postponing a purchase based on interest rates. This has been a conversation I've had a couple of times this week where people were deciding the timing of their purchase not based on their savings or their willingness to move. They were basing it on whether interest rates will go up or down. I think it's very important to consider interest rates because it's a factor in the overall affordability of what home you can purchase. To answer the question, do we think in the long term our rate's going to increase or decrease? I think we just got to understand the economic environment that our country is in right now. We have very high inflation, and everything that I'm reading right now is kind of indicating that we are still not at the peak of what our inflation rates will be. So we should still expect that the interest rates that are reported are going to continue to increase. Now, how high would they get? We don't have a crystal ball, so we don't know that. And are we taking measures right now to reduce, first stop the climb of inflation, and then to reduce it back to the normal levels where we want it to be around 2% as an economy over time. Until the inflation stops climbing, we should expect interest rates to, at a minimum, hold where they're at now, but more likely to increase. At a really high level, what are some positive things that we're seeing that could be an indication that inflation is starting to reach its highest level? And really what we're looking for is kind of slowdown in the economy. Well, commodity purchases are down. Companies are buying less inventory to do production. And one of the interesting things right now is lumber is the one that's had the biggest decrease recently in purchasing off of its peak. But all commodities are down off their peaks. So we are seeing a slowdown in every single commodity. And I think that's a good indication that, at least from a supply-demand perspective, things are starting to slow down and they're going to take some weight off of that push for inflation there. Some other things that we're seeing are the savings rate, personal saving rate is going down. We're also seeing personal credit card debt going up. We've thought the economy's been super red hot for a long time because the consumer continues to spend. Now, consumers are still continuing to spend, but just consider what I just mentioned. They're spending not because their saving rates are going up. They're spending because they're using their credit card to purchase. And that's really a dangerous thing for us, that people are continuing to buy with their old habits, even though they don't have the money to buy. They're basically buying it on credit. That eventually will stop because everyone has limits on their credit cards and they have to pay that off. When that spending stops, it will slow the economy down. A factor that could give us the indication that inflation may continue to increase is just how full our labor market is. Our unemployment rate is at 3%, which is basically zero. When the unemployment rate is that low, the employee has all of the power. And when the employee has all of the power, they demand higher wages. And the companies have to pay those higher wages or else they won't receive their talent. As personal wages continue to increase, that buying power is still high, and those folks will continue to buy goods, they'll continue to take trips, they'll continue to do all of those things because they have the income to do it. So we really, believe it or not, to kind of pull back that long-term inflation increase, we really need a more balanced market with workers and companies' willingness to go hire more people. I mean, we kind of need that to be a more balanced 4 to 4.5% unemployment rate. Because at that point, we actually have people that are looking for jobs. Then the companies that have jobs open can actually go into a talent pool, recruit people capable of doing the job, and not have to pay so much to tear them away from another company. It actually would make our market, our economy, a lot healthier and pull that inflation back a bit. Another big part of inflation is the housing market, and that might be the thing that we can speak the most about. And Bloomberg did a study that I think is really telling on affordability, which is a big factor in whether people go and buy homes. What Bloomberg did was took a house and a buyer with a 10% down payment at 2018's rates for a 30-year mortgage at the price it was. And then if you were to buy that same house in 2022 at today's interest rates and today's values and still put a 10% down payment, The difference in the monthly payment that you would pay for that house in 2018 versus the payments that you would make today for that same house, the monthly carry cost of that home is more than 100% more because of how much appreciation we had in the values and how much increase in rates we've had from that time period. That has an impact. It has an impact, and it has started the slow purchasing down. And if we just zoom in on what we can talk about the most, and that's the Austin real estate market, in June's early numbers of where the market's at, we've seen the total number of sales pull back over 25%. We're looking at 28% is that metric right now. If you look at the number of pending homes, and this is June of this year compared to June of last year, the number of pending homes under contract for sale is around 36% negative year over year. So we're down 28% in the total number of closings, we're down 38% or 36% in the total number of pendings. Our inventory went from less than 1 month's supply, around half a month of supply, to now it's over 2 months of supply. We're looking at triple, quadruple the amount of supply in a matter of months. So the amount of homes for sale versus the buyers that we have to buy those homes, we're getting to more of a balanced market. Now, balanced market is still 6.5 months of supply. And that's why you kind of see housing values still staying about the same or maybe increasing a little bit, is because we still have some work to do on that inventory piece. But if you just look at appreciation from June of this year compared to June of last year, we're at about 8.5% appreciation. It's been a long time since we've had less than double-digit appreciation year over year. We're seeing things pull back, and 8.5% appreciation annually is still a really strong number. The long-term average would be around 4%. And that's, again, when we know things are really healthy, that's what we should expect as homeowners. Now, as investors, is it a good time for us to buy? Always a good time for us to buy, but all the more important today that you buy it right. You buy it with some profit kind of baked in from the very beginning. And you just got to be patient until you find that opportunity to do that. Housing is starting to slow down. It's starting to pull back. These numbers are real clear. And I think because of that, some of our policy is having an impact. We are seeing some of the housing be a factor in the positive direction against inflation. So to summarize, do we believe in the long term that rates are going to decrease, hold steady, or increase? My professional opinion, and it's an opinion, I believe that interest rates are going to increase over the long term. Now, day to day, they go up and down. We saw last week rates fall. This week, we saw them pull up a little bit higher. But that's going to happen day to day. If you were my client and I was coaching you, I would say expect the interest rates to rise. And I think a normal interest rate, if you look at history, is somewhere in that 6.5% to 9.5% range. Today, we're at 5.7%. We're still below what I would call a normal average. And we need to, as a market and as an economy, to be healthy, we need to get up to that 6.5% to 9.5% interest rates. Because that's, that keeps things balanced. It keeps the bumpers on the lane so that we can run a solid growth economy without getting too hot or too low when we talk about recession. So there you have it. If you have any questions about any of this stuff that we talked about, you're always here to help. Please give us a call, and we're happy to walk you through it.